Are we about to see record-setting inflation? Are the wealthy boxing out lower income buyers from the real estate market? What's the future of commercial real estate in a post-pandemic society? I could think of no better expert to answer these questions than a good friend of this channel, and that's the one, the only real estate rock star, J. Scott Shield. Now, you may have seen Scott on Fox Business Channel. He's a frequent contributor to Stuart Varney's program. He shows off his expertise in global finance and investing for the world to see. He's a star real estate developer, serial entrepreneur. He's even a feature film producer. And Scott is super successful, and it is his passion to inspire others to achieve their dreams and impact communities. And so Scott's got a special event in Dallas in a few weeks he's going to be telling us about, as well as a really cool ebook that can help you with real estate investing. So Scott, it's an honor to have you back, man. Welcome. It's an absolute honor.
Dr. Steve, it is a pleasure to be here with you and your audience. Thanks so much for inviting me back. We always love when we get the opportunity, to sit and kind of riff on everything that's going on in the world around us today. Plus, I got to tell you how much I love your audience.
Oh, man. Oh, they're right back at you. They love you, man. All right. So let's start with the big I word, right? Inflation indicators. It does. I mean, everybody's, biting the nails. Are we going to be seeing, do you think, a massive inflation like we haven't seen before, well, since Jimmy Carter days?
Yeah. Unfortunately, I believe the answer to that question is undoubtedly. There's literally every possible indicator that you can look at in play that leads to this, outcome. So as much as, there might be some murkiness in the water, and I'm always impressed by, let's say, all of the uncertainty that is able to be injected into the markets so that the average folks such as ourselves maybe can't get that clear discernment of what's coming. There is almost no way that this can be avoided. The massive run up in debt, the only real true way to pay that debt off is through inflation, and the economic policy makers really understand that. And when we talk about supply and demand issues, that certainly is that's an initial precursor, but I don't think that that's the long-term stimulant. I think the long-term stimulant is the debt. It is really the devaluation of currency, and how that's going to work on a global economic stage. So I think it's coming. I don't think there's a doubt. Fortunately, we have strategies that can be utilized to hedge against that and to prepare, because I don't necessarily think that it's a permanent situation, though. I don't think we are Zimbabwe, where our currency is going to collapse, our economy is going to collapse. I don't think we're Venezuela, but I do think that there's going to be, some short and mid-term pains that we're going to have to brace for, and it's going to be uncomfortable.
So you brought up the hedging. So let's talk about a couple. Let's talk about the market. What's going on with the market in the midst of all this? It seems to have been, well, I mean, relatively stable, I guess, unless you're in cryptocurrencies, you're on a roller coaster there, but the market's been relatively stable in the midst of this. So what should we expect with the market as inflation starts to creep in?
Well, I think you're dealing with some real volatility in the market. And I think it's largely been propped up. I think most who are looking at it are saying, it doesn't make sense. We know we've experienced these disruptions. Has there ever been a time historically when you could have seen, this type of unemployment and this type of spike in the cost of, basic goods and infrastructure costs and energy costs and healthcare costs and food costs, and have it not be reflected directly in the, in the stock market? And the answer to that question is unequivocally no. Typically, the stock market follows the reality of everyday life to at least a degree. It may be lag. It may lead what's going on from a predictive standpoint. So the volatility is here. If you again take a look at history, and I don't mean to keep going back to history, but I know you and I are such students of history, because those who fail to learn from it are doomed to repeat it.
Right.
And at each one of these types of cycles where you've got these extended bull markets and you've got, government spending and massive programs, each time you have what's called a melt up. And the melt up is near the end is when the market froths up the highest. And right now we're seeing unprecedented gains in the marketplace. We're seeing unprecedented highs in the marketplace. And that doesn't belie what's happening boots on the ground.
Right.
If you talk about April, and I think May is coming soon, 4 million people quit their job.
Yeah.
How does that happen, right?
Yeah.
And the rolling back of the the eviction moratorium, which presumably the Supreme Court announced will happen at the end of July, and the discontinuation of the unemployment stimulus support, all of those things tell me that people are going to be scrambling, that the stock market is going to finally reach reality, and that last but not least, when you come out of my industry, commercial real estate, my primary industry, the legislative and the judicial moratorium on enforcement of the loan covenants that are propping up our banking system and our financial sector, that's coming off the table too. So all of these tenants in these, tens of thousands of apartment complexes are now going to face these evictions. And the banks are going to make those non-payments that have really not occurred, right? California Governor Newsom has proposed that the state might make landlords whole on multifamily apartments, properties that are in delinquency. And how's that going to work? That's really not going to play out. That's just more deficit spending. So when that comes home to roost, almost everything in the office sector, everything in the retail sector, everything in the hospitality sector, we're talking, trillions of dollars, are going to be in default, covenant default. And at some point in time, the debt that backs that and the securitized paper that's not performing is going to cause that disruption. And that is, I think, going to be the first domino that eventually causes that pain to really spike. And I see that happening in first quarter of 22.
Okay. So we're about 6 months away, as it were.
Unless they do something again to, artificially forestall that. What happens is when let's say these hotels or these office buildings or these apartment complexes, when they go into default, unlike in residential property, they don't immediately go into this foreclosure box.
Right.
They go into what's called a workout cycle because it's a big asset. And if there's a way for the bank or the lender to stabilize that asset, they want to do that, right? So they say, well, Mr. Landlord, what can we do to get through this to get back into compliance? And so, if there's something that can be worked out, and in many cases there isn't, they know it, but they're buying time.
Right.
They've got 6 months before, let's say they loan $10 million on that asset. After 6 months of non-performance, the balance sheet of the bank shows that asset not at 10 million, but now at 5 million.
I see.
So they lose 50%. That shows up on their balance sheet, usually one reporting cycle later, which is usually a semi-annual reporting cycle. So the banks won't show this up until, third quarter of 22. But by then, the collapse has already begun.
Right.
So we want our folks on this call with you to be aware of the fact that, look, you see the tree falling, get out from that landing zone before it hits. And then once you're out of that, let's call it path of destruction, your ability to step in and help and to even capitalize on that becomes palpable.
Yeah. Yeah. All right. So that leads to the question, where do I step? How do I get out of this? What's the hedge that I need to, obviously the classical hedge for, fiat currencies and inflation is real estate, gold, property, etc. So
true.
Yeah, where should we go?
Yeah, it's a cliche, right? But it's a cliche because it's kind of how it really ultimately occurs. So certainly, I know you've got other folks that work with you on precious metals and those types of things. But in the fixed asset class, I think so many people, when they talk commercial real estate, right? They think of these huge things. They think of these sky-rise office buildings. They think of these massive skyscrapers. They think of these huge retail developments, or they think of these massive apartment complexes. but you shouldn't think of it that way. The reality is that anything over 5 units in multifamily fits into that commercial underwriting box. And what makes that valuable and important and separates it's kind of the fork in the road between residential and commercial investment, because real estate in and of itself is a hedge against inflation. But one of the things that happens is the housing market is so tied to comparables, right? What like it, near it has sold, what it has sold for recently.
Right.
In commercial real estate, once you have 5 units or more, it's now an income-based asset. So its value is based on the income that it generates.
Right.
And if interest rates are rising and inventory is low and prices are going out of control and lenders are locking up because they've got this bad debt, what do? Well, if you're in, let's call it, residential housing in the multifamily environment, now your rents are going up, which means the value of your property is going up. But anybody who's going to try and build a competing property, they're going to be spending big dollars because the cost of raw materials are going up. So the barrier to entry for your competition becomes, much higher, and your ability to capitalize and raise rents, or let's say to hold the line and, keep them, let's say, attractive to stabilize your community and provide a great service and a high quality asset at a fair price, is really at your discretion at that point. So I always tell people, look, it's a great time to get in, but for folks who either have a limited portfolio right now or are primarily in residential, it's a great time to transition into smaller multifamily. And while pricing may be a little high, if you can validate the value based upon current rents versus where market rents are, and then with that projection of inflation, you can see the value creation for the individual really easily. It's a, for someone who works in, let's say, more complex and sophisticated assets, it's something that anybody can get involved in within a very short window of time. It's not like, hey, I need to spend 2 years learning this.
Right.
A couple of weeks, and you can start to work on tangible assets, and reallocate out of some of those riskier things like the cryptocurrencies, and maybe, not facing some of the stock market volatility, or for those who, trade in, Forex and those types of currency things, rather than cryptos. It gets you into that fixed asset, because the cost of a brick is going to be the cost of a brick.
Right.
And housing is a commodity that everyone's going to need. They're going to need that shelter. So you don't want to get caught up in these massive supply and demand issues. The other thing I'll tell you is you probably want to be wary of low income fixed assets where you're dealing with really old, beat up properties where you think you're going to take something that's in a war zone and it's really, it's having a hard time, struggling. It's got a ton of deferred maintenance. And then you're going to clean it up and make it better, because you're not going to get appreciation there. That's a cash flow play for most people. But if you can get in, and you also, I should say, don't want to get into this luxury category, because in the luxury category, that's where the first wave of losses comes, right? If you can stay kind of in that middle ground and serve the middle class, or even the lower middle class, or even the upwardly mobile, let's say economically challenged, that's really the best window for folks to break into when they're starting. And it's most affordable and it's most plentiful. So it really serves a lot of the, let's call it, dimensions that I would love people to focus on when they're considering a transition into fixed assets.
Now, Scott, in addition to your own super successful real estate ventures, you're also a mentor for up and coming real estate moguls, as I like to say. And you do have an ebook that we talked about a little bit earlier, all about getting started with commercial real estate. Can you tell us a little bit more about the ebook?
Yeah, it's called Bigger is Better. It's really been something that we've used to lay the foundation for people who have expressed interest in commercial real estate for nearly 2 decades. It demystifies a lot of things. It introduces people to important terms so they don't feel like they're getting knocked out of their confidence zone because they don't understand what something means. And it shows them, how those terms apply and how they fit, because again, the terms in commercial real estate, which you have to know in order to speak the lingo, is really, kind of nothing more than, let's say, the difference between, someone talking about the biology of the body And we
Right.
say, call it, hey, funny bone, oh yeah, funny bone, I get it. So it's the same thing here for commercial real estate because it's not that tough.
Right.
I know that the powers that be and the halls of
The
upper
elite, shall we
chambers, the
say?
elite,
Yeah, yeah,
right,
yeah.
want to make us feel like we can't do this, but we certainly can. It's a great program. It's an easy read as well. It's well illustrated, so you've got you got graphics to help break it down, and it's free of charge, right? So all you
Oh,
do is
sweet.
go out, say you want it, tell us where to send it, we send it to you, and you can digest it at your own pace.
That's
And
awesome.
you've got questions about it, you can certainly reach out to our organization and our coaches, and we're happy to answer those questions to get people that, again, that solid base to start to understand what they may be able to do in their own lives with this platform. And we found it to be really, really instrumental. And again, it's not tech talk, right? It's not
Right.
techno babble, as Hannah points out, because it really is meant to introduce people who have no familiarity with the platform or the investment asset whatsoever. And we take it one step further there. There's some case studies in there that really show people, kind of how it works to, just to give them some context to really understand.
Commercial real estate for dummies, as it were, right? That's great. And you can click on that link below the video here and get your own copy. That's good and free of charge. It's amazing.